Wait, you got a new camera or no?
No, I'm using my laptop camera.
Why?
Because it's better, apparently.
No.
Yeah. What's happening, everybody? It's your boy Chicago Sean McLaughlin, and Steve Strazza, our head technical analyst here at All Star Charts. This is the Flow Show. What's happening, Strazza?
Not much, man. Another week.
Another week. Hey, I'm liking the fresh haircut, man. You're looking slick. You getting ready for the big conference in a couple weeks? Is that what it is?
Well, no, there's this thing in Florida where it gets really hot this time of year, and the less hair you have, the better.
I remember it well. I spent 5 years in Tampa a long time ago. All right, so yeah, we've had since we last did the Flow Show, the market has had a little bit of a temper tantrum end of last week, and followed through. It seems like it's following through to the downside a little bit today. What do you make of it? What's going on? I mean, are we taking the Fed seriously here?
I mean, listen, we're getting downside follow through, but the most bearish action I'm seeing on the tape this week is energy following, right? So like you had those leaders kind of holding out during the corrective action that started mid-August. Energy and materials kept doing fine, but materials late last week, Friday got hit, and into this week now, 3 really rough days for materials, and now energy is leading to the downside today. So you don't want to see the leaders falter, right?
Right. I know we're in a position in BTU that's not doing so well today.
No stocks fall; they fall, huh?
Oh yeah, they certainly do. They certainly do. And speaking of stocks falling, for a while there we were pretty bullish on the healthcare space, but that doesn't seem to be working out. What's going on in healthcare?
Yeah, so healthcare stands out today with bearish flow. First of all, there's just more bearish flow than usual. I feel like that's something we've been saying past several weeks, right?
Yep.
So, some solid put activity here, a lot of puts on the offer. And we always, I like to start with the indexes. Healthcare stands out. XLV really stands out. We got it right here. It's just a really clean top. And we talked about, and we've gotten into a number of trades. Some of them never triggered, at least in terms of the common stock, because most of them we were trying to buy on strength. But like if you look at some of the bigger components, whether it's Bristol Myers, Pfizer, Merck, we've shown that triple pane chart on here before. All 3 of those stocks I just named look a lot like Bristol Myers, right? They're on the verge of completing these massive bases, it looks like, but it's starting to look like they're going to need more time. When you zoom in, here's Bristol Myers zoomed in just the past few years. Chart's kind of broken,
Yeah, I'd say so. We were in Bristol Myers. We exited this morning. We're also in Merck. It's below our stop loss level right now. So if that doesn't recover by the end of the day, we'll probably be exiting Merck tomorrow, as we like to do. So yeah, healthcare. What's that?
Flipping the book, healthcare?
I mean, when you show this chart right here, it makes me think that maybe we should be flipping the chart.
Yeah, I like this. Like I said, clean top. All those 3 charts that we just talked about that are showing, near-term weakness, 3 of the largest, components in this index. So it's kind of like a bet against all of them. And with those bases, like we talked about this Bristol Myers base, we've seen it a million times. These can take a lot of time. You don't really want to hang out and wait. It looked like it was going. Now that it's not, this could take years.
Yeah, I mean, it's easy to not to overlook at the bottom. Go back to that last chart there. Bristol Myers, it's easy to overlook it at the bottom there on the x-axis. Those are decades you're looking at there. We're not looking at a yearly chart.
It's from the late 90s. We're still trying to absorb overhead supply from over 20 years ago.
Right on. So, all right, bearish options flow. Are you seeing bearish options flow in XLV specifically?
Yeah, so what were they hitting? Puts going all the way out to March next year, 110.
Wow. And it's trading at 125-ish right now. So that 110, I mean, that's a pretty aggressively bearish bet.
Yeah.
March is, I mean, what are we looking? 6 months, 7 months out. So I mean, it's got time, 8 months out. But still, we haven't seen 110. If I pull up a weekly chart here, we haven't seen 110 since late 2019. So,
yeah, right.
Pre-COVID, the before times, Steve Strazza. All right, so I'm looking at this XLV chart here. Let me bring the daily chart back up. So on my screen here at the bottom here, this blue line, this is the implied volatility. The implied volatility is not at the highest levels, but neither is it at the lowest levels. So if we wanted to kind of jump on board of this bearish options flow, I'm not sure buying puts here is the answer, although I don't hate it, Strazza. Like if we really think it's going to fall, I don't hate buying the puts, but I would rather kind of stack the odds in my favor a little bit. Maybe not go for as big of a win, but maybe sell a call spread here. Maybe if we sold like the 130 strike and protected it a few bucks away.
So explain what you mean by that. Like why the bear call spread over just outright puts?
Well, if the volatility was plumbing the depths here of the range that it's been all year,
yeah,
I'd be more comfortable buying puts because if the market sells off, not only are we going to get the direction right, but we're going to get a boost in volatility, which is also going to increase the value of the puts. That's a win-win, right? Yep. But because the implied volatility is already, it's not at the highest levels, but it's neither is it cheap. Yeah. It means we're paying a little bit more to buy puts, and we gotta be a little bit more precise on getting the timing right to really make the trade work for us. Whereas if we sold a bear call spread, where maybe we sold the 130 calls and bought like the 134 calls. I haven't looked at the options chain yet, but just ballparking. And let's say we collected, I don't know, $1.50 credit for that trade. Mm-hmm. XLV could sit here and do nothing for the next month and go neither up nor down, and we could still win. I mean, it could even go up a little bit. It could go up a couple bucks, $2-3. We could still win in the trade, even though we're wrong. So just like that, I feel like it gives me a little bit more comfort. And because the options premiums are a little bit higher, we'll get a little bit more juice to sell that call spread. So it just, I don't know, maybe this is what it is, Strazza. I mean, you and I have laughed about this offline a lot over the last couple of months, but as bearish as that tape was up until about 3 weeks ago in the market, we were having a hard time making money on any short trades, right? I mean, how many times did we get whipsawed out of shorts? Yep. So maybe I'm just gun shy in the whole idea of being aggressively short. So maybe that's why I want to be conservative here. But I just feel like with the implied volatility where it is, selling a call spread would make more sense.
Yeah, listen, I like it also because everything's a chop fest right now. There are other tops that look similar to XLV right now. Look at something like materials where it's undercutting, looks like it's completing a top, ripping back into the range. So it's really messy. I like the fact that the bear call spread really we need much more modest downside to win, right? It's a safer bet. Sure, our upside is limited, unlike it would be just with the straight puts. But I think, to really bet on the market plunging here, when you look at the price action we're seeing in other areas, that's not the bet that I really want to make either. With that said, if this is below 125, you want to have some sort of downside exposure, right? The risk is definitely lower.
Right. So if I'm piecing together a vertical spread here right now on my platform. So if I did a 130, 134 bear call spread in October, which gives us 52 days expiration, we can get about $1.08 credit. You can see it right here. If I bring up this analyze tab, we can. Oh, nope, hold on. I gotta do this little analyze trade. Okay. So this is what the P&L graph of this trade would look like. We're currently trading right here, 125. So we have room to the upside. In fact, between now and October, as long as XLV, stays below, say 131, about 131 is our break-even level. Okay. Right. So we could be totally. We could be totally wrong here. I mean, it's trading at 125 now. It could go $6 up, and we could still make money in this trade potentially, which gives us room to be right. And of course, look, if XLV craters from here, we will make money, but it's not going to be like a home run type trade. It's just going to be a nice, easy, maybe we make 75 cents on the trade. Could be great.
So what makes you go to 130? For the short calls? Why not go lower? Why not like 125?
Again, it's more of well, two things. Number one, selling that call strike out of the money just increases our odds of success. And number two, if you look at my chart here, we got basically a sideways 50-day moving average. And right now that moving average is right at 130. So I just feel like that's a natural spot where we might have some resistance.
Yep. Yeah, that whole zone.
Yeah, so that's it. That's it on healthcare. You know, if we want to sell some premium here, if we want to get directionally bearish to flip our book a little bit, I like this trade. I like selling premium here. So that's a trade we may consider putting on in the next day or so. Did you have any other trades that you wanted to talk about? I think you had Google you wanted to talk about.
Yes, but first caveat, in the next day or so, that's important, right? Let's see the top complete first before we put on a trade like that. We're right there today. You know, any more selling pressure into the close that could break, or maybe we'll get some follow through lower tomorrow.
And look, if this thing sells off further today, which is totally possible, or tomorrow, you know, maybe we still like the trade, but we'll do different strikes. Maybe we'd be a little bit more aggressive with the strikes, and maybe we do sell the say the 128s and buy the 132s.
Yeah, if we get a decisive, you know, completion of this top, get more aggressive. I like that. Google, you want to do the Google quick?
Yeah. So I saw you were asking me about Google earlier, asking me if we were already in it. I said no, but it seems like it's kind of at a I don't know, something's got to give here.
No man's land. Yeah, I was looking through the list, and that name obviously stands out. Huge stock. So there's bullish call flow. What was it? Here's Google. That was from Wednesday last week. They're in the November 18 110s. Stock is trading right around 110 today, right? And then look, it's a mess. So it completed the top earlier this year, and now this is what so many stocks look like right now. Nice base. 2 weeks ago, we were talking about this base potentially breaking out right around here at the 120 level. Failed, rolled over. This is a continuation pattern within the context of now primary downtrend. So yeah, look, we got a nice momentum divergence, but the thing that really stands out, if you look at any of the momentum indicators, is the lack of aggression on the side of buyers. We can't get overbought. So this is all just kind of bear market behavior. I think sideways is an option not too many people talk enough about. I think sideways for longer, messy for longer makes a lot of sense in these trends, but this is what the best stocks look like right now.
Did you say that bullish trading volume is on August 24th?
Yeah,
is that the date?
Yeah.
So interestingly, you said that was at the 110 strike. On August 24th, Google was trading kind of in the 113, 114 range. So they bought in the money options, which is interesting. That doesn't feel like a speculative bet to me. I could be wrong. Totally could be wrong.
Nancy Pelosi. She loves the deep in the money stuff.
I mean, it feels to me that maybe it's somebody who, it's really somebody who's a stock, someone who's more of a stock player, but who's just trying to be a little bit more efficient with their capital. Yeah. Buying in the money calls ties up less capital than buying the shares outright. It doesn't feel like an aggressive bet, Strazza. I feel like usually if someone's got some, inside information or somebody's trying to make a play, they'll usually go with the out of the money options where they can get a lot of leverage for low cost. So I don't know. I'm not buying that bullish options flow there.
I think you make a good point too, because those are the ones that really stand out, right? When somebody's, in some name, $20 out of the money and going out 6 months, those are the ones that are, whoa, or even going out 1 month. I saw it with a bunch of names just in recent weeks. Coinbase, I was telling you about, that was crazy. They were going out like $50 1 week out. But those are the ones that stand out. And you're right, this is the opposite. When I look at this chart, I wouldn't want to make an aggressive bet in either direction either.
Yeah, I mean, if anything, it looks like a delta neutral kind of credit spread possibility, like perhaps a Strangle or an Iron Condor.
And that's another point to it. These are the biggest stocks in the indexes, right? Your Googles, your Amazons, even Apple's showing a little bit of weakness lately, Microsoft. If they're not working, the major averages are going to be going sideways at best. So,
yeah. All right. Well, I guess our big takeaway today from today's flow show is XLV healthcare just hasn't been working for us on the bull side. So Maybe we flip our book a little bit and take a bearish bet on XLV. Let's see how it shakes out over the next day or two. But that might be, selling a call spread on XLV might be the play here over the next day or two.
I like it. It's a really clean chart. And one more before we go.
Oh, sorry.
One that we covered in our follow the flow column yesterday that I do like a lot. This chart is 2 days stale, so it's actually pulled back. This is Mosaic. Listen, we've talked about how materials, have been weak for the past few days. Energy was weak. One day doesn't make a trend. So let's see. I think these could be pretty good buying opportunities in some of these names. Mosaic's been incredibly strong off the lows this summer. We have a clean level here at the 161.8% extension. Now, I think you could buy weakness back towards 56. That's a nice risk reward.
Yeah, if you could see my chart up there, Brandon, I've got the up to the minute Mosaic chart. And yeah, it has come off the last 3 days, but like everything else. So I'd be curious to see how that affected the relative strength over the last 3 days. So that's also something to keep an eye on. All right, folks. Well, thanks for tuning into the Flow Show. I'm your boy, Chicago Sean. He's your boy, Steve Strazza. We'll be back with you again next week. Have a great trading week and catch us on Spaces tomorrow.